Welcome to the Real Estate Guys radio show. I'm your host, Robert Helms. There is a ton going on, so what we like to do from time to time is peruse the headlines and see just what the news means for real estate investors. There's a lot to unpack, and we'll do it on today's edition of Clues in the News on the Real Estate Guys radio program.
Having trouble finding deals where the numbers make sense? Invest in an asset class that delivers cash flow to you in good times and bad, and where most of that cash flow is tax-free. I'm Dave Zook. Many of you have heard me speak at Real Estate Guys events or heard me on their podcast. My team is a top 5 ATM operator in the country, and right now accredited investors can make cash flow returns well into the double digits and get huge tax deductions. For your free report on this lucrative asset class, email atm@realestateguysradio.com.
Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms, and with me, financial strategist Russell Gray.
Hey, Robert.
There's a lot going on in the world, and what we like to do is peruse the headlines and figure out what does it mean to real estate investors. We call that kind of a show Clues in the News. Because what folks are talking about in mainstream media and alternative media and even all kinds of podcasting and publishing, all that can affect investors and real estate investors. So we got a lot of articles to cover today. Probably the big one, lots of different articles on this one. The one I picked came from Associated Press, says, real estate lawsuit settlement upends decades-long policies that help set agent commissions. Now, there's lots of opinion pieces on this, but the basic premise is the National Association of Realtors, one of the largest trade groups there is now having to do away with some of its previous policies. And the speculation is this will have an effect on certainly the real estate agent and broker community, possibly home prices and the ability to be represented. And this last weekend, we had our Secrets of Successful Syndication got together with a group of our students, and we battered around some of these ideas with a panel. So we've got what the articles are saying, and then we've got thoughts from brokers, property managers, and lenders.
Yeah, I think that nobody really knows what the impact is going to be until you actually roll it out. There's always the unintended consequences. I think the basic premise, and you're probably more familiar with it than I am, but the basic premise is that the association, in order to access multiple listing services, you had to agree that if somebody brought you a buyer, you would pay a commission. If the buyer's agent had a right to know that if they brought the buyer, that they would get paid for providing that service. Now that they don't know, it's going to be their responsibility to make sure that when they take a buyer out to look at properties, there's a clear understanding, hey, if I'm going to provide you this service, I need to get paid, and so we have to have an agreement. There was some commentary in our panelists when we got together who said the issue with that's going to be, especially for the first-time home buyers, is the whole process of getting a home to start with is very daunting, very expensive. And now I'm looking at this, maybe 5-figure bill to have somebody show me properties. That maybe is going to be a little bit harder for the rep to do. And they're going to be less inclined to put somebody in their car and just shuttle them around. Personally, having come out of the mortgage business, first thing I saw was, hey, that's a huge opportunity for the people in the mortgage space, because the mortgage space people can get together, help the buyers get pre-qualified, understand what they can afford, which is how it should happen anyway.
Yeah.
And then really go out into the marketplace, and they're not asking for a representation of a commission, and help them. So it's going to be interesting to see if the mortgage community gets a little bit more involved in order to help drive their own business at the same time as how the sellers are going to respond. Because, on the flip side of the equation, you got the listing agent, right? You know better than me. You were a real estate agent for 18 years. If you control the inventory, somebody's going to sell it. If I get the inventory, somebody out there, 1,000 agents in the community, somebody's going to bring the buyer, and I'm going to get paid, and I'm willing to split that to the person who brought the buyer. I can't imagine the people who are getting the listing commission aren't going to be still willing to share. So in the real world, I don't know how much impact it's going to have. it's going to be fun to watch.
The whole idea of cooperation between agents is that a listing agent negotiates a fee. That might be 5%, 6%, 7%, some percentage of the sales price typically. And then they turn around and offer to share that commission or split it in some regard with any agent who brings a buyer. What this settlement says specifically is that NAR has agreed to no longer require a broker who advertises a home for sale on any MLS to offer an upfront compensation. Now, what's ironic, one of our brokers on the panel has been a commercial broker for a lot of years, and he says, when I got into the business 20 years ago, it used to be that in commercial, large residential properties and office and industrial, that agents used to offer a cooperating commission, but really in the last many years, it's not been the case. You have to go in and negotiate that. Now, to your point, Ross, when I'm sitting down and talking with someone who wants to list their property of any kind, we're talking about how do we get it sold? And one of the best ways to get it sold is to offer it to the hundreds, thousands, sometimes tens of thousands of agents in a community to help find the right buyer. So the last thing a listing agent, in my opinion, would want to do would be to cut off the knees of a buyer's agent. There are those folks who say, well, maybe if I get my own buyer, I can make more money. We call that dual agency or double ending the commission. It's legal in some places and not in other places. But I think what this is going to require, and this is the good news, both sellers agents and buyers agents are now going to have to sit down with their client ahead of time and explain this is how it works. If you take the scenario where a buyer, first-time buyer or otherwise, wants to be represented by an agent, and there's a whole host of reasons you want to be, you just have to sit down with that person and say, hey, here's what I charge. There's an excellent chance that the seller's agent, whatever home we end up buying, is already going to be prepared to pay my commission. If for some reason that doesn't happen, you'll know before you have to sign on the line, because that's part of the negotiation, and then you can decide whether or not you want to purchase that property and pay my commission or not. And so it's going to be different. I think it's going to force agents to sharpen their saw a little bit. And I think it's also going to be good for consumers in that they're going to be aware of the duties and responsibilities of their agents and brokers. I think the downside is the same downside we've seen for years in especially single-family homes, where a seller who wants to, quote-unquote, save the commission decides not to list it, but to put out a for sale by owner sign, hoping to save the commission. Well, the fallacy of that is that every buyer knows exactly what that means, and the buyer is going to negotiate down because the seller isn't represented. So two people can't save the same commission. So I do think that this has been a long time coming for a lot of reasons. I can't say that I'm positive or negative about it. I think the short answer is it's not going to have that much effect on most people. And I will make one other point, and that is there's been some talk of, hey, if commissions in general come down a little bit, that could soften prices. That I don't agree with.
No, that's ridiculous. The idea that real estate commissions have anything to do with price is just ridiculous. Buyers don't even pay any attention to that because they don't pay the commission, So the idea that, okay, well, I'm going to pay the commission, therefore I'm going to bid less, maybe, but I don't think so. I think the market is going to determine what the price is. And so if all the buyers got together and colluded and said, oh, I'm going to bid less now because I have to pay this commission. But at the end of the day, I think the houses are going to sell for what they sell for. And I think if anything is going to have a downward effect on price, it's going to be less exposure. So you could make the argument it's bad for the sellers at the end of the day because there's going to have maybe less incentive for buyers, brokers to come out. But in practice, I think what's going to happen is a real estate agent who's got a listing is going to want to get the sale as quickly as possible. It's a short path to commission. Most people who put their home on the market are interested in a quick sale. The best way to get the best price in a quick sale is to have maximum exposure. And the way you do that is by offering a piece of the action to the community. The fact that the MLS or the National Association of Realtors is no longer requiring it to use their platform doesn't mean it's not going to happen. I think it's been practiced forever. It's the way things are done. We're going to find out how it's going to play out, but I think it's probably going to tend to be business as usual. I don't know what the impetus behind all this was, what problem people thought they were trying to solve. And it's going to be very interesting to see how it plays out. But, if I had to predict, I don't think it's going to make that big of a difference.
I heard famous real estate agent Barbara Corcoran talk about it, and she said, the issue is that people have had to disclose for years what the elements of the house are and et cetera, and the commission. And in this case, you're just going to have to negotiate a commission, but the great agents are still going to offer one. There was an article that came out on CNET Money a day ago that says, no, the NAR real estate settlement probably won't drive down home prices, and here's why. And they explain that even though there is a settlement that's $418 million NAR is forced to pay, that the sales commission, just like you said, Russ, is not what drives expensive home prices. Market forces like limited inventory and steep mortgage rates continue to be the biggest obstacle for prospective home buyers. Either you want to be represented or not. I do think the challenge will be for naive buyers who think that I don't need to be represented, and then they're not. And there's a whole host of things that real estate agents and brokers do to protect you as the buyer. You probably need it more from a buyer's perspective in terms of protection than even the seller does. But we could go on and on about this, but the big thing is just to be aware of it. How it's really going to affect us as real estate investors will probably be minimal. It's Clues in the News. Headlines that you've perhaps heard of or read, and now we'll talk about how they affect real estate investors. This next article comes from Market Insider. It says, the looming office real estate crash will be worse than the global financial crisis, according to Fitch. So we've talked about this on the show, the fact that we've got a couple of things working in office. First of all, less occupancy, and that means less physical occupancy, but not necessarily less economical occupancy, because unlike residential tenants that might have a year lease or be month to month, most offices are longer, 5 years, 10 years. So you've got an office park and someone is paying the rent, but no one's actually there, or a lot fewer people are there than used to be because of work from home and all that stuff. And so that is coming. We have leases that are not likely to renew. Add on top of that the fact that the mortgages on those properties now have to be refinanced at a higher interest rate, and you've got double trouble.
Yeah, and this is really important to understand because we are an ADD society. I talk about this all the time. Trends are not events, and sometimes things get put into motion, like the old game Mousetrap when I was a kid. It was fascinating to me. You'd hit the little foot and it would kick the marble and it would roll down the thing, and this whole chain of events would occur, but it took time from the trigger until the trap. And I think that here we've got two ticking time bombs that were buried in the financial system, to your point, Robert. And one is that we shut down the economy, COVID, and we ruined a lot of office occupancy. But because those leases had been signed by big corporations that had long-term leases and balance sheets they needed to protect, they continue to pay on these empty buildings. I just read an article, Amazon is getting ready to shut down and save another $1 or $2 billion a year because they've got a lot of unoccupied office space. Well, there's still a lot of that out there, and that economically has not been felt in the bond market. And when I say the bond market, I mean the commercial bond market. There's mortgage-backed securities or residential RMBS, residential mortgage-backed securities, and there's CMBS, which is commercial mortgage-backed securities. And so the way the money gets to market is you have people who invest in these securities, these bonds that are pools of all these mortgages. They're backed up by Main Street real estate, whether they're residential or commercial. Well, in the commercial, to your point, the leases are not 1 year, not 2 year. They're decades in some cases. And so that's one level of problem. So for the owner, they've got income for now, and they've got loans that are locked in at rates that were very favorable for 5 years, 10 years, 5 or 10 years ago. The problem is now, as rates have spiked at a rate unprecedented in American history, certainly, but maybe in the history of the world. I don't know that interest rates have ever gone up so far, so fast from where they were to where they are. Some people say, oh, the interest rate's only 5% or 5.25%. Yes, but it started at 25 basis points. So if you do the math on that, it's a 20 times growth. I mean, even when Volcker took interest rates up to 18, he started from a base of 8. So he didn't even do 3 times. Whereas this is 20 times. So the impact, the jolt, the shock on people's cash flows and balance sheets is really profound. And that has not worked its way through because these cash flows have continued on these empty offices with these leases. But when those leases expire, that office building owner is now not going to have the income to make the mortgage payment. There's not a line of tenants to lease the property. And when those mortgages reset, they're going to reset at a much higher interest rate or need to be refinanced at a much higher interest rate. And that just smells a lot like default. And what happened in the great financial crisis is that these residential mortgage-backed securities had ticking time bombs called subprime loans, many of which were on these 228 teasers. So you get a 30-year loan, but it was 2 years at the super low teaser rate so you could qualify. And then it was going to reset in year 3. So people had like a $1,500 a month house payment. And then in year 3, it went to $4,500.
Right.
Well, that was a wipeout. And so they were betting that they were either going to be able to refinance the property and credit would be available, which as it turned out wasn't, or that they would be able to sell the property because there would be equity and they would walk away with the equity. And they were speculating using these cheap loans in order to bet on the movement of real estate. Well, it's the same thing. Only a small percentage of those loans went bad, but it only takes a small percentage of loans to go bad in a big pool. Because if you got something spitting off 4 or 5 or 6% yield and you have a 6 or 7 figure default, that eats up a lot of yield. Right. And so all of a sudden the bond is underperforming. It drops in value. And when that happens, if these bonds have been leveraged, you get margin calls. That's what created the liquidity crisis in 2008. And on a scale of the numbers involved, that was much smaller than the scale today. And I think what Fitch is saying is when this thing finally blows, it's going to have a profound impact on the credit markets. Everybody calls it the real estate market, right? We didn't have a real estate crash in 2008. We had a bond market crash. And the credit markets, which is the bond market, took the air out of the real estate market. And so people who had equity watched it disappear. I think the same thing is going to happen in office. But when credit markets go bad, it affects more than just the real estate space. It'll affect all credit markets. So one of the things that I'd be doing right now is looking at my portfolio, looking at my business, looking at my life. How dependent am I on healthy credit markets? That's a SWOT analysis I didn't do in 2008. I was very, very dependent on healthy credit markets. And when credit markets broke, everything I had fell apart. So now is the time to really be thinking about that. As John F. Kennedy says, the time to repair the roof is when the sun is shining.
Well, back last time around in the great financial crisis, it was also residential based. And because of that, there's another nuance here. We saw prices go down, but not for long because people jumped back in, moms and pops, institutions, and bought up residential property because the need for a home or apartment did not change. In this case, the need for an office building is changing. According to the article, office values have dropped so far an estimated 35%, and that's less than the 47% plunge that we saw during the great financial crisis. But this latest situation offers no reason to expect the descent to slow. When those things happen that you talked about, Russ, when the tenant moves out or can't pay, when the owner can't make the mortgage payment and the bank takes over the property, property values go down. And there aren't a whole bunch of people waiting in the wings with their clever property reuse ideas. Sure, we've seen a few office complexes get retooled as different types of uses for real estate, but the vast majority are not going to be able to for a whole host of reasons. So this is definitely one to keep watching. It's Clues in the News, what's happening in the world, and what it means to real estate investors today on the Real Estate Guys radio program.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Hey, it's Robert Helms. Thanks so much for listening to the show today. I want to personally invite you to come see an amazing real estate market that combines excellent cash flow, offshore diversification, and what we affectionately call lifestyle investing. Come join me from July 19th to the 22nd in the beautiful country of Belize. The Real Estate Guys have been bringing investors to Belize for more than 18 years now, and our discovery trip is designed to show you the market like nobody else can. Sure, Belize is breathtakingly beautiful. The people are wonderful. And wait till you taste the food. But the real opportunity is the real estate investment potential. There's all kinds of opportunity in Belize when it comes to real estate, including both long and short-term rentals, commercial and retail triple net properties, business opportunities, land acquisition, development, agriculture, and more. And as the only country in Latin America with English as its official language, it's easy to understand the law. Property rights are strong, and contracts are in English. And in the top tourist market, a unique situation exists where demand for rentals continues to outstrip supply, creating a compelling environment for investors. So come see for yourself. Join me July 19th to 22nd in Ambergris Caye, Belize, as we study the market, learn about the sustainable drivers, and tour lots of beautiful real estate. And like all of our field trips, there are no properties for sale during the weekend. Rather, you'll meet lots of local providers that will help educate you about the market so that you can follow up with them after the trip if the market is interesting to you. You've heard about Belize on the Real Estate Guys for all these years. Now come see what all the excitement is about. Plus, we'll have lots of time over meals and activities to talk about all things real estate. To get the details, go to the website at realestateguysradio.com and click on Events, where you'll find the Belize Discovery Trip. Once you register, you'll get information about our group hotel rates as well as travel details. So join me in Belize, July 19th to 22nd. It's a beautiful country with lots of amazing possibilities, and the only thing missing is you. Go to realestateguysradio.com under Events, and I look forward to seeing you in beautiful Belize.
Hey, this is John Asraf, and you are listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program, now in our 28th year of broadcast. It's Clues in the News, what's happening out there in the world, what folks are talking about, and reading beneath the headlines to see what it means to you and I as real estate investors. This next headline is something that we've been talking about on and off for longer than we probably should be. That's because the headline is, we are experiencing the longest yield curve inversion in history. So the yield curve teaches us a lot, but no investor left behind. Russ, what do we mean when we talk about the yield curve?
So when you plot out where interest rates are on short-term securities, bonds in particular, and call it the 2-year bond, you get a rate. And then further out, you have a rate, say, at the 10-year bond. And if the interest rate on the bond further out is higher, then you can imagine that if you were to draw a curve or draw a line, the line would trend up.
And that would make sense just from a logical point of view. The longer we're going to commit money for, the higher we would expect to get.
Correct. So when it inverts, it means that the further out you go on the curve, the rate gets lower, which is counterintuitive.
Yeah.
And so for a lot of wonky reasons I won't get into now, you listen to George Gammon and he can explain it to you, but it presages a recession. In fact, it has a 100% track record. 100% of the time the yield curve inverts, it's followed by a recession. And so there are people right now who are saying, hey, this time it's different because it's been so long. Well, when I saw the article that said, hey, it's been 625 days, I get people who are waiting for the event and can't patiently understand that, yeah, if I stay in this river long enough, it's going to go over the waterfall, right? Because that's the trend.
Yep.
That, it's like with the dollar. People go, oh, yeah, the dollar's strong. Well, you know what? If you look at a 100-year chart, the dollar has a clear trend.
Yes.
And at some point, it will go over the edge and the trend will become an event. History says all fiat currencies fail. It says that all reserve currencies one day are no longer the world's reserve currency. And that's another trend we've been looking at. And that's a discussion we can have at a later time. So when I read the article and I saw the 625 days, one of the things I noticed it said was the last record, the one that it just broke, was August of 1978. And I thought, well, that's interesting. What was going on in the 70s? Well, that was stagflation. And what's interesting is for the first time since the 70s, you've been hearing talk in media and economists talking about this strange animal that most people listening to the show probably weren't alive for, not old enough to understand. Sadly, I'm old enough to remember it. I remember being in the 70s and stagflation. What stagflation is where you have growth by the numbers. Prices are up. Profits are up. And if you gauge by that, the economy is doing well. However, in the real world, with jobs and real wages, now real wages is the difference between how much you're earning and how much things cost. And if things are going up faster than your wages, even though your wages are going up, in the real world, you're going backwards. So that's what stagflation is. Stagflation is when the numbers are going up, but the economy is actually receding. And so people have a hard time getting their mind around this. I don't know if we have time. I've explained this in the past. I did it on Ken McElroy's show. I did it on our Investor Summit. I think people find it helpful to understand kind of how it works and why you can have numbers going up and people, whoever in power, it doesn't matter, blue, red, whatever administration, doesn't matter, right? If the numbers are up, people run around taking a victory lap. But on Main Street, people are struggling. Right? They go to the grocery store, it doesn't buy as much. They get their paycheck, it doesn't go as far. They have a job, but it's not as good or it's not as stable. A lot of those numbers can be massaged around. And I think it's this concept called nominal confusion where the numbers confuse you.
Pretty interesting.
Yeah. So it's really common sense when you stop and think about it. And I tried to break it down into something we could all relate. Normally I would have a chart or a graph and a PowerPoint, but on the radio, you can't see that. So just in your mind's eye, imagine a company that's selling a million widgets a year for $10. So it's a $10 million company. And let's say that every employee can create 100 widgets. So they need 1,000 employees, right? So now that's your business. Now, let's say that because of inflation, say it goes up 20%. So now a widget that costs $10, now you have to sell for $12.
Yep.
Okay. And we've had 20% inflation over the last 3 years. So this isn't just like pie in the sky. That's a real number. And so now at $12, that company can't sell a million widgets because 10% of their customer is out there on the margin and they could afford it at 10, but they can't afford it at 12.
Right.
So now instead of selling a million widgets, they're selling 900,000, right? So that's a 10% reduction. But if you do the math, 900,000 times 12 is 10.8 million. So when they were selling a million widgets, they were a $10 million company. Now they're selling 900,000 widgets and they're a $10.8 million company. In other words, their business has grown nominally by 8%. But in terms of product that they're supplying in the real world, benefiting real people, they're serving 10% less people.
And then you've got the employees making those widgets. If they're making less widgets, you don't need as many employees.
They go from 1,000 to 900. So now you have an economy or a company that's growing. It went from $10 million a year to $10.8 million a year. They're selling 900,000 widgets, 10% less product going to benefit the marketplace, and 10% less jobs, 100 people out of work. And so you can have a recession in terms of production and employment while you have expansion in terms of number. And that's how inflation distorts the numbers and confuses people. And so if you're there and you're trying to make projections about long-term investments, you have to understand that we're seeing shrinkage. The bond market is telling you that they're not bullish on the future, they're bearish. And that's what the yield curve inversion means. And the fact that it's taken this long means that people are confused, I think, for longer about what's really happening because the numbers are confusing because stagflation is extremely confusing, both for investors and business people.
And it's been a while. And of course, this has been tossed around. Is it stagflation? Is it not? So it's good to be educated so you can recognize the clues. Another thing that came out in the news was Janet Yellen. Do you want to take that one?
Well, I mean, yeah, she came out. She famously said, and this kind of goes hand in hand with this other discussion. She said back in the very beginning when inflation started to show up that it was transitory. Jerome Powell, chairman of the Federal Reserve, it's transitory. All the talking heads on TV, transitory. This is because of COVID, supply chain. We're just going to flick a switch, open up the economy. We're going to get productive again. Everything's going to be fine. But that's not what ended up happening. Inflation turned out to be very sticky. Some people said, well, that's because we gave a bunch of stimulus money. Once we wear that off, it's going to be okay. We'll raise interest rates. We'll tamp down purchasing power. And if you think about that on its face, that's tough. Right? Because what they're doing by quashing demand is they're saying to Main Street, the people who are out there trying to buy stuff, I mean, I don't know about you, but I like buying stuff. And so when stuff gets more expensive and I can buy less stuff because they put in higher interest rates and higher energy costs and higher regulations, I don't feel richer when I can buy less stuff. I feel richer when I can buy more stuff.
Right.
So I don't think it's good for the economy, to deal with inflation by suppressing purchasing power. I think you need to expand supply. But at any rate, so she says it's transitory. Well, I did a presentation the first time we did the Investor Summit on land or on sand in Belize. And my presentation explained why inflation was going to be sticky. way stickier than anybody thought. And my argument was based on an article I read in 1999. I remembered reading this article in 1999. I searched, I found it because I archive everything, and I found it. And in CNN on October 29th, 1999, Alan Greenspan was quoted. He was the chairman of the Federal Reserve at the time. He was defending his low interest rate policy at the time as not being inflationary. And he said the reason that they weren't seeing inflation was because productivity gains from technology had absorbed it or muted it. And I thought to myself, well, what he's really saying is that lower prices, higher profits, higher wages that all should have occurred and accrued to the economy were stolen by inflation so that that money wasn't available to be reinvested in more productivity. The basic concept is that you produce something, you make a profit, you reinvest your profits in more production, and as you expand production, it drives prices down. The natural order of things, because business people are always trying to do more for less so they can win market share and make more profit. The natural order of things is deflation. And as a society deflates, goods and services become more affordable and people have more stuff. So the whole idea that inflation is good is wrong on its face. But now when you think about it, I mean, a lot of our folks here are listening, they're real estate investors. If you have an apartment building and you know someday you're going to have to replace that roof or repave that parking lot or make some major capital expense, every month, you know it's coming. Every month you're investing or setting money aside so that when that inevitable day comes, you have the money on hand to make the repair. Well, imagine if in an economy or like you're a tech company, the money you should be investing in R&D so that you have competitive products in the future, so you have more productive capacity in the future, and you're not making those investments. Those investments are being stolen through inflation or through whatever means, in this case, it's inflation. That means one day when you wake up and it's time to repair the roof, you're not 1 year, 2 year, 3 years out of position. You're 20 years out of position. In 1999, 25 years ago, Alan Greenspan is saying all the productivity gains that we should have been investing in our economy, we haven't been because we've been stealing it through inflation, have put this economy 25 years out of position. When that inflation whale breaches the waterline and comes out, it's going way past. That was my prediction back then. Not going to be transitory. It's going to way overshoot, and they're going to have a heck of a time getting it back down. And that's exactly what happened.
Well, it's interesting. You made that prediction, and the next day, Dr. Doug Duncan, the chief economist for Fannie Mae, got up and said, I completely agree. I don't think this is transitory. I don't think it can be.
That's right.
And now here we are all these years later, and now Janet Yellen is saying she regrets saying it was.
Yeah. And the irony, it was a half-baked apology because she said she's sorry for using the term because it confused people who clearly didn't understand what she was saying because we're not bright enough to understand what she says. Because in our world, transitory means, temporary. In her world, transitory means something else that nobody else knew what it meant until now. But clearly it's not temporary. So it's something as investors and entrepreneurs we're going to have to account for and deal with and study, because not only is it not transitory, it could even get worse before it gets better.
It's Clues in the News, what's going on in the world and what it means to real estate investors. We'll have some of our own news before we're done, and we'll play real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
So what are you doing at the end of April? Why don't you join me and my good friend Jason Hartman for the Empowered Investor Cruise? Yeah, it's a 5-day cruise with some awesome ports. Plus, we'll hang out, have meals together, have collaborative learning sessions, hands-on workshops, roundtables, and exclusive networking. I've known Jason Hartman for nearly 2 decades, but this is the first time I'm going to get to attend his annual Empowered Investor event, and it just so happens to be on a beautiful celebrity cruise ship. So join us. All you have to do is go to empoweredinvestorlive.com. That's empoweredinvestorlive.com. You'll see all about the ship, the sessions, the ports, and the amazing time we'll all have together. Go to empoweredinvestorlive.com, and I'll see you on the Empowered Cruise.
With everything going on in the world, don't let your lack of financial understanding derail your investments. Real estate investors need to see the bigger economic picture. The Federal Reserve, bonds and interest rates, precious metals, oil and gas, cryptocurrency, and the inner workings of monetary policy, just to start. If you're at all confused about how and why market metrics intersect and what it means to you as a real estate investor, take your understanding to a new level with the Future of Money and Wealth video collection. Discover the opportunity to hedge against inflation, deflation, and stagflation. Gain critical insights on real estate niches that perform well in challenging times, and learn specific strategies to fortify your balance sheet before it's too late. Simply send an email to future@realestateguysradio.com for all the details. The Future of Money and Wealth includes 20 videos of powerful presentations and panel discussions featuring Robert Kiyosaki, Peter Schiff, G. Edward Griffin, Dr. Doug Duncan, Simon Black, CPA Tom Wheelwright, Brian London, Dr. Chris Martinson, and many more. Email future@realestateguysradio.com today.
Hi, this is Kevin Harrington, an original shark from the hit TV show Shark Tank, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, come hang out on the 22nd Annual Investors Summit at Sea. It takes place in June as we depart from Fort Lauderdale, Florida, and visit an awesome, beautiful part of the world while hanging out with folks like Ken McElroy, Peter Schiff, Tommy Hopkins, George Gammon, Brian London, Jason Hartman, and lots more. Get all the details by sending an email to summit@realestateguysradio.com or go to investorssummitatsea.com. It's clues in the news, what's happening in the headlines, and what it means for real estate investors. Before we get back to that, let's play real estate trivia. Give you a chance to win a cool prize by knowing today's real estate trivia question. It'll have something to do with real estate. When you hear the question and know the answer, send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. Give us your name, the answer to the question, and your physical mailing address, because if you're the first to get it right, you're going to get an awesome best-selling book from our friend and CPA Tom Wheelwright. It's called Tax-Free Wealth. That can be yours if you know today's real estate trivia question. Last week we had Peter Schiff on the show, who lives in Puerto Rico, and we asked this. Puerto Rico is officially the Commonwealth of Puerto Rico. It's actually an unincorporated territory of the United States. Our question was, who officially discovered the island back in 1493? The answer, Christopher Columbus. Puerto Rico was first discovered by Columbus in 1493, and several invasion attempts were made by the French, Dutch, and British. During his journey, Christopher stayed on the island for 2 days. Peter stays there at least 183. Here's our real estate trivia question for this week. Which country has the highest level of public corruption? You have all the countries in the world. Which one's the most corrupt? If you think you know, or just want to take a guess, send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. We'll need your name, the answer to the question, and your physical mailing address, so that if you're the winner, we'll send you Tax-Free Wealth by CPA Tom Wheelwright. That's today's real estate trivia question. We're talking about clues in the news, what's happening, what it means to real estate investors as we're perusing the headlines. Near the beginning of the year, we had attorney Mauricio Arrould on the program talking about the Corporate Transparency Act, which nobody's very excited about, but the fact that you need to be a little more astute and you need to pay attention to the law requiring you to disclose ownership and actual addresses of anybody who owns more than 25% of an enterprise. But the article that came out this week said the Corporate Transparency Act has been deemed unconstitutional.
Yeah, it was interesting. So the National Small Business Association decided to sue over this, and it ended up in a federal court, not the Supreme Court. And they were contending that it violated your Fourth Amendment right to privacy. In other words, unless you're the subject of an investigation, unless there is some compelling reason and a judge has issued a warrant saying that you need to reveal your private information, that you shouldn't need to. And they won. And the challenge, so before you get too excited out there, is that the exemption from the Corporate Transparency Act only accrues to the people who were members of the Small Business Association or the class of the plaintiffs at the time the judgment was rendered. So if you weren't already a member before March, whatever the date was, you're not going to be able to take advantage of that. Doesn't mean you shouldn't join, with the idea that maybe somewhere down the road something else will happen and you want to be part of that class. It's good to know that there's an organization out there pushing back. But, a big part of being an investor, we talk about this whenever we talk about asset protection, is being invisible. And if you could trust banks and even the government with your private information, that's your decision if you think you can trust them. I think there's been enough data leaks and breaches and things being exposed, tax returns being exposed, banks getting hacked. I think anytime your information is owned by anybody other than you, there's a good chance that you could be exposed. And of course, marketers get into that information and then they use it for whatever purposes. And so if you're the type of person that values your privacy and understands your constitutional right to have your privacy protected, and just a side note, the Constitution doesn't give you the right to privacy. It protects the right to privacy. The founders concluded or asserted that your right to privacy was a God-given right. In other words, you were born with the right to privacy. You were born with the right to own property. You were born with the right to assemble. You were born with the right to speak freely and a lot of other rights. If you look at the Constitution, they've created the Constitution not to grant those rights, but to protect them.
Right.
Just a sidebar, but just so you understand that we don't get our rights from the government. The government gets its power from the people. Anyway, so there's a big tug of war going on right now for all kinds of rights. And in this particular case, your right to privacy is really being infringed upon, in my opinion. I'm definitely against it. I think that there's a lot of things that happened ever since the Patriot Act in 2001 that have infringed upon Americans' privacy in the name of fighting some elusive enemy called terrorism, which can be defined any which way you want. And it's really been a challenge. So it doesn't mean there aren't things you can continue to do and you should do. There are different types of structures besides entities, legal entities, which are creatures of statute. There's things called trusts. But when you enter into the banking system, the bankers are all going to subjugate themselves to these requirements. And so it's going to be very difficult in a conventional financial system to conduct business without being fully outed. You might say, well, I don't have anything to hide. Well, that may be true, but we're also finding out, and now maybe I should put on my little tinfoil hat, but we've seen that sometimes there are people who take a political stance or they say something in public that people who are in power don't like. And all of a sudden, their access to your information can put you in their crosshairs. And so you may not think much of it, but it does tend to keep you in line a little bit. And I do think that the reason our First Amendment, what we're using today, here and now, was put there is so that people can talk freely about policies and positions and ideas that they disagree with. Doesn't mean they're right. Doesn't mean when you disagree with something, you're right. But it means that the chance of finding the truth and getting to the truth is better when there's more voices heard. So I'm not a fan of censorship. I'm not a fan of invasions of privacy. I'm not a fan of infringements on private property rights. So I'm happy that the National Small Business Association decided to fight it. I think that it's something we're going to continue to watch, and we'll see. It wouldn't surprise me if this thing ends all the way up in the Supreme Court, and then maybe one day it'll land on the side of the Constitution, and we'll end up being able to preserve our right to privacy, unless we're proven to have done something wrong, guilty or innocent until proven guilty.
I talked with Mauricio a couple days ago, and I talked to Garrett Sutton a couple days before that, both attorneys who understand asset protection, and what they're saying to their clients is, for now, follow the rules. That may change, and if it does, great, but let's be careful out there.
But you don't have to like them.
Yes. Another article came out that says, this is not a surprising headline, California leads the nation in unemployment after slower job growth than anticipated. According to the article, California now has the highest unemployment rate in the nation after new data revealed that job growth in the Golden State was much lower in 2023 than previous believed. So they have net outmigration. People are moving out. There's less jobs. Minimum wage is up. A lot of things going on in California. This isn't to pick on California. It's just to illustrate that when you're a real estate investor, population matters, jobs matter, and we want to go and put real estate in places where there is going to be an abundant supply of tenants.
Well, and policy matters. policy is what creates this. When you create an environment, it's either going to be conducive to entrepreneurs and job creation, or it's going to be repulsive to them. And, it takes a lot to overcome inertia, whatever it is. And so if you get a reputation for being a friendly place, then you maintain that reputation maybe longer than you deserve it. And if you end up doing the wrong thing long enough, eventually you get a reputation for not being very friendly. And it's no secret. It's not conspiracy theory. I mean, the polls are based on the people that they ask. And of course, people are voting, as you mentioned, Robert, with their feet. They're leaving. When you create policies that are unfriendly, California has been at the bottom of the list. Now, they benefited from tech, and tech has been a big part of it, but even the tech companies. I mean, Elon Musk moved Tesla out. Apple put a big thing in Austin. Intel, a long time ago, moved to Phoenix. I mean, so this has been going on for a long time in California. If you want to understand this, go back and study Detroit. And Michigan in particular. So at one point, Detroit was the world's wealthiest city. Population of 2 million people, had the wealthiest people. It was Motown. It was the home of all automobile manufacturing, in which we led the world. Best jobs, great manufacturing base, that being the cone or the primary driver, and created all kinds of secondary and tertiary business around it. But over time, the policies that Michigan implemented eventually took Detroit from 2 million people to 800,000. And the businesses and the jobs and the manufacturing left. And then before a while, and it took decades, Detroit became the poster child for the largest municipal bankruptcy and some of the worst real estate investment you could ask for. They were literally bulldozing the houses or giving them away if you would just pay, $2,500 to pay a tax bill or something. And so I'm not saying a place like that can't come back. I mean, I've heard some good things about Detroit making some changes. But, when you go to make an investment in real estate, you're getting married to a market. Typically, it's a 10, 20-year investment. And if you're going to do that, then you have to look at the long-term trends. And you have to say, okay, where was this place at 10, 15 years ago? Where is it at today? What does that trend line look like? What's happening today, and where do I think it's going to go in the future? And then you need to make a decision. Am I getting on a rising tide, or am I getting on a sinking ship? And I think that there are a lot of people that are fans of California, and I came from California. I get it. But I think that you need to look at California and what they're doing and ask yourself, as a real estate investor, based on their landlord law, based on their tax law, based on their business climate, if that's really going to be the place of all the markets you could be in. I think if you look at where real estate is really shining, no pun intended, it's in the Sun Belt. Some of the southern states that tend to be more business friendly. That's where people are moving. That's where businesses are moving. That's where jobs are being created. And I think that, all things being equal, you probably want to concentrate more on markets that are a little bit more friendly with policies that attract people and businesses and jobs, and a better place to be an investor.
Back in 1997, we started the Real Estate Guys radio program in San Francisco, California. When I met Russell Gray, we both lived in the Bay Area, and today neither of us do. They chased us out as real estate investors. It is a beautiful place to visit and a terrible place to own a business or invest, in our opinion. It's Clues in the News, what's happening in the headlines, and what it means to you as a real estate investor. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Forbes rated Memphis the best cash flow market in the nation. And our good friend Terry Kerr at Mid-South Home Buyers has been the premier turnkey rental property provider in Memphis for over 13 years. With an A+ rating from the Better Business Bureau, Terry has renovated over 750 houses. Real Estate Guys listeners have snapped up hundreds. Discover what these satisfied investors already know. Mid-South's properties are completely renovated with a 1-year warranty and a lifelong rental guarantee. They're affordable, well-managed, and easy to own. Perfect for beginning investors and veterans alike. Get in on the action. Contact Terry and his team via email at midsouth@realestateguysradio.com. All aboard! Registration is open for the Real Estate Guys 22nd Annual Investor Summit. Imagine spending more than a week with like-minded investors, world-class educators, and real-world professionals. Returning in 2024 is the editor of the Gold newsletter, Brian London, real estate developer Beth Clifford, and the rebel capitalist George Gammon. Back with us in 2024, sales legend and best-selling author Tom Hopkins, and Joining us live and in person for his 12th Investor Summit, Ken McElroy. Plus 2 brand new faculty members we can't even mention yet, and a lot more. It all begins June 13th in Fort Lauderdale, Florida. Visit investorsummitatc.com to get all the details and reserve your spot. This transformational week is like no conference you've ever attended. Go to investorsummitatc.com and make plans to spend a week with the real estate guys, Ken McElroy, Tom Hawkins, and an all-star faculty on the 22nd Annual Investors Summit at Sea.
Hey everybody, it's Ken McElroy, and I'm on with the Real Estate Guys, and I'm very excited to be a guest and a speaker at the Investor Summit coming up. If you haven't signed up, be sure to do so.
And welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, we're headed to New Orleans for the annual New Orleans Investment Conference. This will be the 50th annual New Orleans Investment Conference. It's going to be a ton of fun, and we'll have the legendary Real Estate Guys Party. If you want information about the event, and you do, just send an email to neworleans@realestateguysradio.com, neworleans@realestateguysradio.com, and we will both see you there. It's clues in the news, things going on in the headlines, and what it means to real estate investors. This last article in Forbes says how immigrants are boosting U.S. economic and job growth. So we are not political on the Real Estate Guys, although we pay a lot of attention to policy, as Russ articulated earlier. But our friend Ken McElroy shared this with us on one of our Collective Inner Circle calls. He was looking at the effect in the apartment business, especially when it comes to, in this case, illegal immigrations, or I guess we call them newcomers, folks that are coming in illegally, and then they have a hard time getting jobs and getting places to stay. But he said, if you'll detach yourself from whatever emotion you have about that, it means that we need more roofs for people to sleep under.
Well, and in this article, Fed Reserve Chair Powell said that, it's just arithmetic as far as immigration's impact on the U.S. economy. If you add a couple million people to an economy and a percentage of them work, there are going to be more output. And this is really an interesting conversation, not just here in the United States, but around the world. China is famously having a demographic problem. Japan had a demographic problem. And to a degree, the United States had a demographic problem. Organic or natural births here in the United States was falling. Our birth rate was falling. Now we've got borders that are fairly open, and we got a lot of people coming in, both through legal and illegal means. And at the end of the day, to your point, Robert, doesn't matter if you like it or not, if you think it's good or not, they do have an impact on the economy because they're here. They consume goods and services. In some cases, they're being given purchasing power before they're even productive. I think at some point, people are going to find a way to be productive, in the black market or not. It doesn't matter. If you go out there and you find a way to make money, whether it's in the system or under the table, you're still making money. You're still creating productivity of some type and purchasing power of some type, and you're going to need to buy goods and services, including housing, at some point. And so if you're looking at that, you think, where are these people landing? What kind of jobs are they getting? What type of housing might they need? And, whether you think that would be a place that you would consider investing because of that demand. But you cannot ignore it. You can get into why are we doing this? Well, maybe we're trying to compensate for a falling birth rate. Maybe we know that we've got a Social Security problem and we need more people working. So we got to get these people in fast, get them naturalized some way through forgiveness, amnesty, whatever it is, and get them in the system paying payroll tax to keep the Ponzi scheme of Social Security going. I don't know. I don't know what the motives are, right? Nobody in Washington is calling me up and saying, hey, Russ, what do you think? I just try to look at what's going on. But clearly, as investors, you need to pay attention to the fact that these people are here. More of them are coming, and they are definitely having an impact on the economy and real estate in particular in the places that they're landing.
And that's really the big message. It's not, you probably have an opinion about it politically, but set that aside and just say, okay, if there's going to be more people demanding housing and other uses for real estate, does that create opportunity? And that's what we do when we take a look at the clues in the news. Hey, before we get out of here, we have some news of our own.
Yeah, so it is kind of big news. It's bittersweet, I suppose. You know, if you've listened this long, hopefully you're a fan of the show. I've been sitting in this co-host seat since June of 2004, so going on almost 20 years. And Robert and I met because I had set off to do something in the area of investor education. I was looking for faculty, and I found Robert. We became friends. We started teaching together. A couple of years into that, the original co-host of the show quit, and I stepped in as the temporary co-host. We've joked about that many times, but and some of you who follow the show for a long time know that a few years back, not too long ago, my wife of 41 years died. And when that happened, it kind of shook me a little bit, and I thought about really everything I wanted to do with what I have left in my life, and there's some things that I'd like to go do, and I decided I needed to take some things off my plate to go do them. And one of the things I decided that it was ready to move on from was sitting in this seat. So it's been an amazing ride. Robert and I are going to continue to work together as partners in the Collective Inner Circle with Ken McElroy, George Gammon, and Jason Hartman. We're going to continue to work together in training up syndicators to raise capital and help Main Street invest in Main Street through our syndication mentoring club. But I won't be here every week in the co-host seat for the Real Estate Guys radio show. I'm going to extricate myself from a lot of the back shop operations of dealing with the operations of the business. And I'll be at events. You know, we talked about being at the New Orleans Investment Conference. I will be there. I won't be there as the Real Estate Guys. I'll be there in some other capacity, but I'm going to continue to circulate in the tribe. If you're one of those folks out there, that a small percentage of people in the audience that actually come out and visit with us from time to time, you'll still see me around. I'm not going anywhere. I'm still very much involved in what we do and the mission, you know, empowering Main Street to invest in Main Street and empowering individual liberty through financial education for effective action. My personal mission statement, that doesn't change. And it's going to be very exciting to see what Robert does and where he takes the show. Haven't really talked about that yet, but this is something we're super excited about. If you want to keep track of me, just send an email to follow@russellgray.com. And I just want to say thanks to everybody that has been faithfully listening all these years. We love all those notes and cards and letters that you send us. Fans, you've been fantastic. It's been so fun. Robert, thank you for allowing me to sit in the seat all these years and all the things that we've been able to do together. I mean, it's sad when I think about it, you know, but all things kind of not really come to an end, but maybe shift direction a little bit. So I'm excited about going forward and some of the things I have on my plate. And I'm excited about the Real Estate Guys. And I know that it's going to continue to be a very valuable voice in the cyberspace out there, helping people get focused and take advantage of the ever-changing landscape that we see. It's only going to get harder. Your ability to read and react to what's going on and take advantage to find the opportunities and avoid trouble. You're going to need a lot of good ideas, and you're going to find a lot of good ideas here on the show. So keep listening, and some of the things I'm going to work on, you'll be able to hear about that too.
It's been a great run and a long chapter in the Real Estate Guys history, and the next chapter starts next week with an awesome guest who's got a brand new book, and the week after that, George Gammon is back with us. Hey, if you want to hang out with Russell Gray, Robert Helms, George Gammon, Jason Hartman, and Kenny McElroy, then you ought to think about joining our high-level mastermind. It's called the Collective Inner Circle. To get the details and be invited to learn more, just send an email to collective@realestateguysradio.com, collective@realestateguysradio.com. Until next week, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and Rich Dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys radio show.